Hey everybody, Stock Picks by Tim, back at you again, and today I'm going to get into senseonics. At the end of the video, I'm going to show you a short clip of the earnings call. It was a 30-minute conference call, but I cut it up into about 5 minutes, and I gave you just a couple of the parts that stuck out to me. But we're going to get into the technicals, we're going to see what the analysts at TipRanks think, and then we're also going to end it with that clip. But let's get into the video. Alright everybody, now first starting off with the analysts, we've got 4 ratings as a strong buy, a $4.50 price target representing about a 21% upside. And looking here on the left, we have a couple of recent analysts. So these last two that covered senseonics were actually on November 9, so we did have some recent coverage. They must have listened to the earnings call and decided to cover this one, but we do have a 5-star that gave it a $6 price target, which is a nice 61% upside, and then we also have a little over a 4-star, giving it a $4 price target, which would give it about a 7% upside. So the analysts think there's definitely some potential here with senseonics. They did actually beat their earnings per share by 45%. They reported a 3-cent loss, which was expected to be 6 cents, and their revenue did miss, but only by 1%. So they did report a $3.5 million revenue, which did increase over the previous year. Now in a second here guys, we're going to look over the chart, but I just wanted to show you real quick that with this being such a low market cap at a $1.6 billion market cap, we ran up so quickly on decent enough earnings. Earnings was good, not bad at least. And of course it took it back just as fast, being that this is one of those kind of speculative stocks. It totally depends on FDA approval for it to just have a very, very successful future, although I am very confident, as well as it seems that the executives are pretty confident as well, that they are going to get that FDA approval, and they have said in their conference call that I will show you in a second here, that they are working closely and they are getting up to the end of it here. But, it is to be expected that when something runs up like this at almost a vertical line up, of course it is going to come down and touch back to reality. Now I did scoop some shares up here at that 370 level, and I will be looking to buy some more here, especially if it can reach the 200-day EMA or about 360. And if it can do that, that would just be fantastic. But, the sell-off was to be expected because the RSI became overbought. When you look at the 1 month, right where that spike was, it became overbought, and this doesn't like to be overbought for very long. It does reach the small euphoria stage where it becomes overbought, and then it quickly comes back down. I'm going to continue to buy here if it can come down further. I'm kind of expecting it to come down a little bit. I did start a small position, a starter position here on this, and I have had this before. I got in before in the 2s, got out when it hit 4, but I figured, hey, where it's at, with how much progress they've made, they're working on the 180-day being FDA approved. It is in Europe currently, and they're making revenue off of it there, and the fact that they were going to, after that, work on their whole year, 365-day CGM, continuous glucose monitoring. They're going to be getting that one in Q1 of next year. They're going to be working on that and moving forwards and just continuing to upgrade and improve their product. And I'm very excited to hear that. But we're going to leave it off here. I'll see you guys on the next video, but I'm going to leave the clip here. It was like a 20-something minute video, and I cut it into about 5 minutes with a couple tidbits of info that I figured you guys might want to listen to. And we're going to roll the clip now. But thanks again, guys. See you on the next one.
We are encouraged to be able to sustain our full year guidance and exit Q3 anticipating being in the middle of our range, given that our guidance for this year had been established with the expectation of the U.S. 180-day product contributing to 2021 revenue. At this point, we of course do not expect contribution from the 180-day version this fiscal year, and are happy to maintain the earlier forecasted revenue despite the delayed FDA approval. Our collaboration with Ascensia continues to advance, and together we have developed and are implementing several promising programs targeted to drive HCP and patient adoption in the U.S. At the highest level, we are focused on, first, raising awareness of the clinical benefits of the world's only long-term implantable CGM, and second, increasing patient access to the Eversense technology. To accelerate the healthcare provider certification process, for a limited time, eligible HCPs will be provided training sensors at no charge. This program is targeted at increasing the number of inserters and make it more convenient for patients to get our long-term sensor. Finally, as Eversense requires insertion by a healthcare professional, it offers a reimbursement pathway unique within the CGM market. Payers such as Cigna and Medicare reimburse Eversense through our established CPT codes, enabling the billing of both the product and the procedure in one claim. This can greatly reduce the burden and time it takes for a patient to obtain CGM versus the traditional processes of durable medical equipment. To facilitate adoption and ensure healthcare professionals always have product in their offices to accommodate new and recurring patients, we are developing a consignment program that allows clinicians to stock Eversense in their offices. Having product on the shelf in the HCP's office at all times can enable fast, even same-day insertions without having to manage the inventory or carrying costs. On the innovation front, we are excited to be approaching our major release of our next generation product in the U.S. with the FDA clearance of our 180-day sensor, which we believe remains on track to occur later this quarter. The FDA has been a great partner in these difficult times, and they are highly engaged and focused on completing this review in its final stages. We continue to advance our future generation Eversense system. The development of the 365-day sensor that will require only one calibration per week continues to be the goal of our efforts. We do continue to expect the formal pivotal trial will be initiated in the first half of next year and would form the basis of the clinical data that we would submit to the agency for commercialization approval in the future.
In the third quarter of 2021, total net revenue was $3.5 million compared to $0.8 million in the third quarter of 2020. U.S. revenue for the third quarter was $0.6 million, and revenue outside the U.S. was $2.9 million.
With the authentic commercial infrastructure in place to support a productive 180-day Eversense product launch, we believe that the foundation created by our new commercial partnership and the longest-lasting CGM on the market positions us well to capture meaningful market share. I certainly would never say that there's no risk. We are in active review at this point. Certainly earlier in the year, having their resources to be able to get back to the diabetes technology was the issue for all of us. I won't say that they're back 5 days a week, but they are back the majority. So certainly would never say there's no risk, but it's our expectation based on the cadence of the interaction and the iterative review that we've been through, that we are encouraged and very much feel and believe that we're headed in that direction. That's an area we continue to focus on. The premature failure rate is about 3 or 4%. In the U.S., and those are sensors that will go early based on the body's oxidative response. But obviously, the design of the 180 is to certainly significantly moderate that.